As we move forward, I'd like to discuss the origin of the option market. I found this fascinating. I thought to myself, this was something that took a genius to recognize, understand, and then create 2,000 years ago. What was the first ever option and options trade? The first options were used to speculate on the olive harvest by a Greek philosopher, Thales. By studying the stars, Thales predicted there would be a vast olive harvest in his region, and he felt and thought there would be a significant demand for olive presses. So what are olive presses? It's very interesting. I traveled to Spain, and I, at that point, never gave much thought to how olive oil was created. And as we were traveling through the hills of Spain, you would see these different farms, and they all were growing olives. And my thought was, at that point, how do olives create olive oil? And what happens is they obviously they pick the olives and they put them in these machines that spins them around so fast that it pulls all of the oil out of the olives. And depending on how fast the presses spin, and depending on what kind of olives are in the presses, you create the different types. However, Thales did not have enough money to buy one of these olive presses. So what he did instead was he paid the owners of the olive presses a certain sum of money to secure the rights to use them at the harvest time. As expected, it was indeed a huge harvest. Thales resold his rights to the olive presses and made a sizable profit. So let's really break that down. What did he think, and what did he create, and what ended up happening? Because it is going to be the exact same thing that happens in today's marketplace, and it is the exact same thing that happens with stocks or ETFs that we purchase options on. He went to the owners of different olive presses and said, I would like to pay you whatever the value was at that time for the exclusive right to use your presses for what I believe is going to be an outsized olive harvest. And I will be the only person that is allowed to use them, unless I decide, because I'm not obligated to use them, I just purchased the right to use them if I decide to. However, if I decide not to, I am given the right to then resell my right to the olive presses to someone else. And depending on whether or not I'm right, the price of those olive presses and the use of those olive presses could skyrocket. And as we can see, he was correct, and he eventually sold his right to use them to another party and clearly made a profit, because there were so many olives that needed to be converted into olive oil that the presses became in demand at a much higher rate than anybody expected. Therefore, he has effectively created the first call option with olive presses as the underlying security. I thought that was very interesting, and I thought that it would really give everyone a true understanding without using all of the current investment terms to try and figure out what a call option is or what a put option is. He simply said, I want to have the exclusive right to use your olive presses. I'm going to sell it to you today. I'm going to give you what you would like today. And I'm not quite sure where and what kind of harvest we are going to have. But if I'm right, and there is an outsized harvest, the demand for these presses is going to skyrocket. Therefore, I Thales will be able to sell my right to using them to someone else. The evolutions of options trading in America was made famous in the 1920s when a man, Jesse Livermore, speculated on stock price movements. He did not own the underlying security or stock he was betting on, but merely predicted their future prices. When we use the word prices, we also have to make sure that we are also focusing on the movement of the stock in the future. But the future does not have to be the very last day the option can be worth value. It can simply be 1 minute ahead of when the option is purchased, or a week ahead, 30 days ahead, but at some point in time in the future. He was a stock option bookie. In this day and age, we no longer use the phrase bookie when it comes to options. And he would take the opposite side of anyone who thought a particular stock might increase or decrease in price. So let's use a quick example. If you believe that Apple stock is going to move up in value, you might decide to go to the options market, type in Apple stock symbol, go to the options chain, decide on which direction you feel the stock is going to move, and purchase either a call option or a put option. A call option is designed to profit when the stock goes up, and a put option is designed to profit when the stock goes down in value. We will discuss that in much greater detail as the lecture continues. He was willing to bet that the stock was not going to do what the buyer of what he was selling, whether it be a call or a put option, he said, I don't believe that Apple stock is going to go higher. Therefore, I will sell you the right to my stock. And if it does not do what you want it to do, I keep your money and I keep my stock. So the challenges of trading options back then, we tend to take the technology available to us today for granted. And one of the reasons I decided to really go into the history of the options market is because it's of my opinion that technology really gives people a false sense of confidence in buying or selling options because you can skip right to a couple of clicks and be in a position rather than starting from the beginning and understanding how it evolved. And once we understand how it evolved, we'll be able to start at the beginning of how to really pick a successful stock as well as pick a successful position in regards to whether it be a call option or a put option. The market for options continued to essentially be controlled by put and call brokers. These contracts were traded over the counter. There is still an over-the-counter marketplace in today's market. What the over-the-counter marketplace is and how does it differentiate from the New York Stock Exchange, the NASDAQ, the Dow, etc., is that there is no regulation. And most securities were either listed on one of the actual regulated stock exchanges like the New York Stock Exchange and raised capital, and then in the future were unable to keep their business up and running, and the stock price dropped below the required value in order for it to be listed on one of the regulated exchanges. However, there is now this over-the-counter market where you can still buy and sell stocks, except they're often referred to as penny stocks. And the big difference is that the over-the-counter market is not regulated. You can publish any type of fake information, or in this day and age, we refer to it as fake news, and potentially increase the price of a stock with news or with information that is inaccurate or a blatant lie. It also remained relatively illiquid with limited activity at the time. There are current stocks, massive stocks, and stocks that everyone on the planet knows that also currently have, in this day and age, illiquid markets. One of the most famous companies in the world, Amazon, it does not have a very liquid market for options. And one of the reasons why is the price of the options are they're very high. It's not uncommon to pay $7,000 for one contract, and that is an extremely high value for one contract. And the price of Amazon would have to make a substantial move in order for you to make money, whether it be on the upside or the downside. The brokers at that point in time were making their profits from the spread between what the buyers were willing to pay and what the sellers were willing to accept. However, there was no real correct pricing structure, and the brokers could set the price in their favor, or in more simple terms, they could set the price at whatever they would like. Let's discuss what a spread is really quick. The spread is the difference between the price that someone has to pay to buy and the price that someone has to pay to sell. So the spread between, let's say, Apple stock is $1. That means that if Apple stock is trading for $100, the spread is going to be, you have to purchase it for $100 and you have to sell it for $101. And the person that is facilitating that exchange or that trade makes the difference. They make that $1. The formalization of options trading took place in 1973. However, prior to the CBOE, or the Chicago Board of Options Exchange, the Securities and Exchange Commission, better known as the SEC, tried to bring new regulation to the over-the-counter options market. However, there were too many complexities and inconsistent prices, and it made it very difficult for the SEC to regulate option pricing and allow there to be a fair marketplace for buyers and sellers. At some point in time, they decided that they needed to create an official marketplace similar to the New York Stock Exchange, where investors and options traders would go to, and it would be a specific place where the option pricing would be set by the entire marketplace and all of the investors. As we just mentioned, it's called the Chicago Board of Options Exchange. It is very popular, and it is it was something that was desperately needed at the time, because options were gaining popularity because they were an inexpensive way to profit off of an opinion on where a stock price was going to be in the future. So after 2,000 years of Thales creating the first call option, we finally had the ability to trade options in a fair and legitimate, regulated exchange. Again, the Chicago Board of Options Exchange, or CBOE. I want to thank you again for hanging with me. I hope that the structure of the course, and starting out with the history of both the stock exchange and the options market, will start to build the foundation of what it actually means to purchase a call option and a put option, and what they are designed to do, and how your opinion will give you the ability to profit or reach your desired goals based on the movement of the stock.